Welcome to Blockchain Week Day 4. In this session, we're going to be discussing the financialization of everything and the role of DLT with our keynote speaker, Todd McDonald. He's the co-founder and chief product officer at R3. Over to you, Todd.
Thank you very much. And thank you for having me at Blockchain Australia Week. I'm really happy to be with you for the next 20 minutes or so. And I wanted to share some perspectives on what I'm seeing in the market, what we're seeing in the market at R3 as it relates to, I guess, this overall theme of the financialization of everything and what does that mean, especially in the markets that we operate in, which is regulated financial markets. So for today, I wanted to talk about these four key market drivers that we're seeing and more importantly, how those are driving choices for investment in three different areas. One, probably a big topic for this week is what type of convergence or bridges will there be between DeFi and traditional finance or TradFi. Secondly, and this is something that we're extremely close to, we're reaching this install phase for regulated digital asset networks. And I think very apropos for this week, things like Project Dunbar, regulated digital currency, it's not an if, but a when. So before I jump in, I just wanted to level set just really briefly on R3. Some folks in the audience that are listening, maybe you know a little bit about R3, maybe you know a lot. I just wanted to maybe reframe where we are today at R3 versus potentially where you might have heard of us before. So we were very fortunate to launch the company back in 2015, and we started life as a single bank consortium. We were quite fortunate to attract a lot of interest and participation from the world's largest banks. But we realized pretty early on, and what we've been focused on over the last 5 or 6 years, is instead of creating a single consortium or a single network, we could really flip that on its head and offer our software, our platform, our services, our expertise, our support for the success of multiple consortia, multiple networks. At the end of the day, that's what this type of technology is not good for, but it's great for. So where are we today? We offer two trust technology platforms, Corda, our DLT platform, and Conclave, which is for confidential computing and privacy enhancing technology. And we are focused on building the new foundation for finance, in particular for digital assets and value networks. And importantly, those that are built on trust and with the right partners. And I'll talk a little bit about that today, not from the specifics around what we're doing in R3, but more around how we're seeing things in the marketplace. So what are some of these big macro drivers? And a lot of these are not necessarily too novel, but I think it's quite important to understand what is driving the activity and investment in these big macro themes. So the first thing is we have been living in an age of the digitization of everything. We've been in this big digital transformation. And one of the byproducts of that is that everything can eventually become financial. And we are starting to see that where everything is becoming an asset. And I think very importantly, this is not just in, say, the crypto context of the ability to create assets, although that is quite important. You know, the marginal cost of creating a net new digital asset is being driven close to zero. And so what do you see? Much like when the ability to publish information on the internet went to zero, you see a lot of information being published, and not all of it is of high quality. But there is still obviously some incredible value there. And this is what we're seeing on currently on the digital asset side. And this is driving, as we'll talk about later, the need to number one, cope with this, number two, take advantage of it and try to build infrastructure around being able to take advantage of the potential for these net new digital assets that emerge to be able to be transacted and held into regulated and distributed networks. Next thing is, you know, when you're talking about value, the idea of safety is really, it's non-negotiable. And I think, you know, it is important that the definition of safety depends in large part on those users or those that are experiencing or trying to use those things of value. But it is true that the definition of safety will be determined either by the users or eventually by the regulators. I didn't really mean to pick such a sort of a intense picture of Gary Gensler here, but I think it does capture that quite well, that it's not just about regulation, It is about the rules around interacting, handling, managing these increasingly digital assets, and especially things like when businesses are transacting, the ability to be able to transact with their customers, with their supply chain, has to be done in a safe manner. There's really a different definition of safety than say potentially the risk that a DeFi degen would be able to be living with when they interact with a smart contract. Third thing is that in being in the blockchain space for quite some time now, oftentimes requirements start with decentralization, or decentralization is a given sort of requirement for lots of projects. But what we've found, and I think actually a lot of people within the crypto world have found, is that sort of the intensity or the shape of decentralization really does depend on the network. And a lot of times it comes in the form of progressive decentralization. And this is something that you can take a class with Andreessen Horowitz's crypto class around progressive decentralization. This is not just something within traditional finance. This is something that, as we see either net new networks being formed or traditional networks, existing networks being modernized into this digital market infrastructure, as we'll talk about, there's a move to be able to distribute participation and distribute access to those networks, but it's usually done in a hybrid fashion, and it's not always a net good to aim for decentralization. And then the fourth thing, and I think maybe also potentially obvious, but one thing that we've realized, and obviously you see in the crypto side, is that, as I mentioned before, R3 started as a single network, but we realized pretty early on there would be many, many networks, and that has borne out. Obviously, within crypto, there are more and more networks every day that are getting funded, that are being launched, and also, interestingly, in the regulated space, early on, we recognize that those that are existing and operating within an established regulatory perimeter, within a zone of sovereignty for a currency or a securities market, they not only want, but they need to be able to create their own network. But we still have to manage and handle having all of these networks. It's still incredibly important that we don't create something that looks like this eye chart here, something where assets can potentially be discovered across multiple networks and potentially transacted across, and not necessarily in sort of like a sort of a network hopping wormhole perspective, but in a way where regulated networks, and especially regulated networks of value, can come online, get live, and transact across those networks at a time of the choosing of those participants. And that's incredibly important, something we'll come back to when we talk about digital currency. So great. Everything's becoming financialized, everything's becoming an asset. We need to understand how to make this safe, and especially safe increasingly for businesses and regulated financial institutions to be able to interact with. The topology of these networks really should fit the requirements of the networks that are trying to be launched. And there's going to be a lot of these networks. So what does this mean? How is this playing out? And what are some of the areas of investment, in some areas where we're not necessarily today seeing some of the investment, but there may be some coming down the road, or we may see things develop a little bit differently than people expect. First up, there is clearly an opportunity and a threat to existing financial incumbents when it comes to cryptocurrency, crypto assets, and the overall DeFi space. In being part of the founding of R3 in 2015, we lived through a few hype cycles and periods of intense interest in the crypto markets. And it is clear that there have been different waves here, but I think when you think about DeFi and some of what it's trying to accomplish and some of the things that are happening there, it is a little bit different than what we saw in the early days of R3 when people were trying to grapple with the likes of what Bitcoin would mean for their business. It's much closer to the heart and soul of what regulated financial institutions do today, credit, lending, et cetera. So that's incredibly interesting. So attention must be paid 100%. And also, what are the features? The features within the DeFi world very specifically are about things like automation, programmability, and I think quite importantly, the ability to take a smart contract and use that single smart contract as a pool of liquidity And instead of a peer-to-peer interaction, you can have peer-to-pool with multiple peers interacting with that pool. So what's happening is we're getting lots of experimentation, lots of innovation within DeFi itself, and also increasingly speaking about sort of the rules of the road. There's different rules of the road within DeFi. Certain things that are potentially features within DeFi, like increased financial transparency, and in some cases composability into arbitrary sort of computer code, potentially is not a feature, but really a bug or something that is regulated players are looking to avoid. So what does that mean, and how are traditional financial players really interacting with this emerging world? So there's a few different things happening, and in looking at the agenda for this week, it is clear to all of us that crypto has been de-risked as an asset class. So you are seeing, and increasingly we're seeing existing financial institutions, large and small, and some incredibly conservative ones, looking to package up crypto as exposure to the underlying asset class for their customers, whether that is for the private bank, wealth management, or to the investment banking product. And importantly, this is in a way where those customers can get exposure without having to actually handle some of the underlying operational risk. So that is definitely happening today, and that investment's happening. What we have not yet seen, but there is a potential to see, are this real explosion of digital assets within crypto networks. As I mentioned before, as the cost goes near zero, more and more of these assets will be created. The vast majority of these assets will really not have much interest for either institutional investors or those that are looking to conduct business within the financial realm. But it's clear that some percentage will be eventually. So there's the beginnings of the appetite to build bridges within and into regulated traditional finance, into these traditional financial networks that have an established regulatory perimeter and established rules of the road. So that's starting to emerge, but not really there yet. What we have not yet seen are regulated liquidity pools being allocated into these DeFi pools. Not yet. I know there's some work going on there, but there is not. I think the risk reward for regulated financial institutions right now is just not there to be able to enter those markets. And we're still not seeing traditional FIs providing services directly to within this sort of emerging regulatory perimeter of DeFi. Some of these will to be seen, but what we are spending more time on, and what the market's spending more time on, is how do we work to set up these digital asset networks within the regulatory perimeter that have the capacity to create and list new and novel digital assets that look like traditional assets, or take traditional assets and package them in other ways. And eventually, potentially, being able to, whether it's list wrapped crypto assets, or potentially bring in some of these arbitrary digital assets into these networks. But importantly, within the regulatory confines of the emerging digital market and infrastructure, which is the next big theme that we're seeing. So the second big area is we are and have been entering into the install phase for digital assets and the digital asset ecosystem. When we started R3, a lot of what we worked on, a lot of the use cases that we're focused on were cost save use cases. How can we solve for reconciliation? How can we eliminate some of the duplicative processes? And there's still a ton of that effort going on, and you're seeing that in especially in the post-trade world for financial services. I think interestingly is that more and more the revenue imperative has come to the forefront in the form of regulated digital assets. So we are seeing an increased investment from incumbents and others to create digital market infrastructure to handle the full life cycle of assets, from issuance through settlement and the entire life cycle management of those assets. So these are just some examples. I just wanted to point out one or two here. One is our partners at SDX, Six Exchange, last year, at the end of the year, launched there, and they had the first bond issuance that was fully regulated. And very, very interestingly, as we'll talk about, they have the capacity and the ability to settle that bond and the other digital assets they will be listing into cash that sits at the Swiss National Bank. That's one. And two, you have started to see more and more, and obviously something that within the Australian ecosystem, ASX was a very early investor in this technology to try and revamp and revitalize and renew their infrastructure. Some of the use cases have matured from then, and I would point out the work that DTCC is doing on a few fronts. One in their digital securities, their Project Whitney, where they're offering services to private securities, in some cases private crypto securities, and their Project Ion, which is this journey from settlement of T+2 to T+1 to eventually accelerated settlement that can happen intraday, and all done on DLT. So really exciting stuff happening there. And then the third part is digital currency. CBDC, or central bank digital currency, obviously has been a huge focus, something that we work on quite a bit. And over the last 5 years, this has gone from maybe if this would happen to when this will happen. So there is a ton of work going on specifically at central banks, across central banks, and importantly, not just in central bank digital currency, but in what are the ways that we can bring regulated settlement assets that are represented as either central bank digital currency or commercial bank money in digital form for security settlement, and also into the retail CBDC sector. So there is an enormous amount of activity here. And of course, not all activity will lead to outcomes. We've seen in R3 many projects start, not that many finish into production, which is typical for any really transformational projects. In CBDC, though, the sheer number of projects is staggering, and the investment is really just at the beginning stages. And so you'll start to continue to see this. This is also driven by the need for a settlement asset for these for the digital assets that are being listed as well. And of course, just this week we've had the release of the Project Dunbar report, and this brings together a few different themes that I wanted to touch on today. One, clearly, this is an investment in digital currency by, the very definition of incumbents in the central bank space, and importantly, organized not just within a single central bank, but a network of central banks. That's the first part. Secondly, this is meant to try and explore to solve how can we have multiple networks of value that can still transact across each other and still try to solve for some of the challenges with cross-border payments. And I think third is, what are the uses of this digital currency once you have this multi-CBDC platform? It really is going back to the ability to increase or reduce the settlement times, bring in accelerated settlement, and be the other side of that delivery versus payment for digital assets. So this is just one example just from this week. There is many more to come. So what does it all mean in total? And some of the things that we're seeing. Just a few observations to leave everyone with. I'd say first, cryptocurrency, it has survived as an asset class through some crypto winters. It is being packaged up to institutional investors and banks, but I think importantly, fintechs are trying to be that channel, that trusted channel, and trust is an interesting word in crypto, but it is true, to be able to give the exposure for these crypto assets and shield their customers from the risks of trying to interact and hold them. DeFi ecosystem definitely is something to pay attention to. This is something a theme I come back to. It is financial history being rerun at 10x speed. And so you're getting all of the good and bad with that. But as of yet, we have not seen this crossover into traditional finance, although we continue to get inspired by some of the aspects like automated market making and others into traditional finance. So there's a bunch of threats externally to regulated finance. There's a lot of innovation happening. So it's not just cost savings, it's about net new networks, especially in digital assets and these automated trusted value networks. They're going to have regulated digital currency, and especially CBDCs are going to happen. Will happen on a central bank timeframe, but they will happen. And last, we are living through and will continue to live through the financialization of everything. And this is not just something that's happening in crypto, but it's happening within traditional markets, traditional finance. And we are at this install phase where this new foundation for these really net new digital assets are being installed today. And right now they are attracting liquidity, they're attracting collateral. And I think importantly, they are going to be attracting high quality settlement assets like digital cash. to be able to bring together the promise of DLT and the promise of digital assets and currencies into regulated financial markets. So that's just a whistle-stop tour of what we're seeing. And with that, I wanted to thank you for your time and enjoy the rest of your blockchain week. Thank you. Have a good day.